In this lesson, we'll look at a comparison of discretionary and algorithmic trading. I won't tell you which is better, but I will tell you about the pitfalls, advantages and disadvantages of both, quick and easy, and in such a way that you can decide for yourself. Let's do it. In discretionary trading, the decision to enter or exit a trade is made by the trader. How? Based on his experience and intuition, and on analysis, a lot of different ones. A trader like that must know a lot. He's limited by the fact that he has to sit in front of a screen and watch the markets. He's often in a different time zone than the market itself. In practice, this means that he is often working in times when he would normally be asleep, for example. On the other hand, for a good discretionary trader, trading must be a real passion, and when you really love what you do, you simply enjoy it. He also has absolute control over the trades, and he can catch some unexpected nice opportunities in the market. Now, one big thing, a discretionary trader must have absolute control over his emotions, and that's really hard. I have a huge amount of respect for that, because I can get annoyed by the fact that the store doesn't have my favorite pasta brand. Now, what about algorithmic trading? Algorithmic trading is easier in many ways. You ideally create a portfolio of strategies that complement each other at the start. You can code them, or you can create them in strategy Quant, for example. You create the entry and exit conditions of the strategy, so you tell the strategy exactly when to trade and when not to trade, when to enter and when to exit. You don't need to know complex market analysis. You don't have to sit in front of a computer for hours. You deploy the strategies into your account, but just please test them sufficiently on a demo account beforehand, for goodness sake, and then just check how they are doing, maybe twice a week. But you need high quality data to test the strategies on before you deploy it, so be picky. You rely on technology, so you have to build that strategy really well. In your portfolio, you have to ensure all possible market scenarios, so you can't do that without some knowledge. Also, you can possibly miss some super duper opportunities. There's also a risk that you so-called overfit the strategy, which means that you refine and optimize the strategy until it's unusable. And the big thing now, you don't need to control your emotions so much. The robot trades for you automatically. So you can feel free to get mad at your baker for not having your favorite type of bread. And it will not affect your trading. Whichever option you choose, there are a few other things to know. Trading is a business like any other, even the algo one. It's demanding, sometimes stressful, and sometimes you'll be overwhelmed. You need the right mindset. Many of you start out trading alongside your main job. That's why it's important to think about your mental and physical health. Create the right working environment and the right habits and so on. And exactly this and much more is the topic of a mini-series on the algo trading psychology, which we will kick off next week. So give a like and follow and stay tuned.